The question was, what about having different models to enter, says G. It is better, or excuse me, is it better to stick with only one to avoid analysis paralysis, or rather not? So I'll give you what I think, okay? The market moves in different phases, okay? There is a video I did a long time ago, not a long time ago, but there's a video I did a few months ago, and it's called MMXMs or Wyckoff, Why Framework Matters, okay? Because again, the market moves in cycles, okay? So it doesn't really matter if you look at, say, MMXMs or Wyckoff, all right? The point is, let's just say the market runs liquidity and then seeks opposing liquidity, okay? It's kind of probably not the greatest drawing in the world, but it's cool. So there is a model that will allow you to trade up to liquidity. There is a model that allows you to short the liquidity to go lower. There is a model that allows you to wait for liquidity to be swept, then break down, then, short the next available retracement to go lower. There is also a model that allows you to wait for the last leg of distribution or the last leg of accumulation to go higher if this were inverted. So again, you have a model to go up to liquidity. That's one. You could short liquidity. That's two. You could short the next retracement after liquidity run. That's three. You could short a late entry model. That's four, right? At least four. So there's obviously more than four trading models, but just to give you an example, there's four right off the bat. So I think G, and again, I'm just speaking general terms here. I'm not calling you out or anything. I'm just saying, but think about that. If you have just one model, okay, I'm going to short, let's say the first retracement after a liquidity run. Okay, cool. That's your model. So if you're waiting for that, you're watching the market trade up to liquidity. You're missing those moves. You are, what are you going to do when you see your model, but you come to the chart a little bit later? Let's say there's a 5-minute time frame and this was like 10:30 in the morning your time, but you don't get to the chart till noon. It's 12 p.m. and your model is already played out, so you can't enter the market because it's not your model, right? But then you have, say, a downside target down here that you believe the market's going to go for. So because you missed it for whatever reason, you got a job, you maybe just had an off day or something, I don't know, whatever reason you missed an opportunity, you're not going to take a later opportunity and then you're just going to watch the market trade down here. So you're just going to be watching markets and never trading and just watching and watching and watching. Now, mind you, I watch the markets a lot, but I'm looking for trades. I'm looking for actual trades to take. I think having just one particular model is a flawed logic. I think it's a flawed idea in the long term. So if you're a beginner trader or even an intermediate trader and you just want one, maybe two entry models, or, let's just say entry models, right? Then that's fine. One or two in the beginning. But because the markets move in stages and there's a specific like entry model around each of these stages, I think having one or two is very limited. Does that make sense? So let's go back to the Dow Jones and with what I did on Friday, okay? Where I had the lows down here and I shorted like right up here. I took a little bit of drawdown on this, but then it ran straight for the lows and I took profit there. Boom. In, a little bit of drawdown, out, done. that is one aspect, like that's one model right there. If I wanted to be bullish, which I wasn't, but one idea, I could have longed below the lows to go up to that high. I could have entered that and exited there. I wasn't looking for that. But that is one of the models. Buying below old lows. Your stop loss is my entry. That's a model. Shorting bullish retail flag patterns, that is a model. I hardly ever use it. But I used it. This was the first time this year that I faded a bullish retail flag pattern. That was the first time this entire year. It's been it's March 11th. It wasn't until a few days ago this year that I shorted that, because again, I've seen this happen so many times that fading retail patterns to me is a model by itself. Right? No need for what breakup structure. I don't see any breakup structure here on a 5-minute time frame. Not really. I mean, I guess you could force it maybe, but it was just, hey, observe the masses, do the opposite. Done. That's its own model. That's the kind of things that I'm looking for, right? Dow was the last domino to fall. Go watch that video if you don't understand, again, why I shorted that. So if I was waiting for a retracement that never happened, right? Let's say this imbalance up here. Oh yeah, I want to short that. It's going to clear the highs, rebalance price, I'll short that and then go down to the equal lows. Well, it doesn't do that until Friday, right at the tail end of the session. And the lows have already been swept. So now I don't have a target anymore. So then I wouldn't have taken the trade anyway. And I wouldn't have held over the weekend. Now, in hindsight, sure, it does come down for the lows that I pointed out on Friday. But that would have been a hold over the weekend, and this could have easily gapped higher if it wanted to. So that wouldn't have met my criteria anyway for a trade idea. Right? So again, think about, I'll walk you through this one more time and then we're going to hop off here. Okay? I wasn't bullish Friday morning. Okay, this is strictly hindsight. I'm just trying to teach you some things, okay? Say this imbalance up here. Say you thought this gap was going to be filled. Okay. Well, there are entry techniques down here to enter. There, even like that morning on Friday, even though there's lows right here, there's imbalances that were respected to go higher. That's a model. If you have lows here and you feel like this gap, if you treat it like an imbalance and you want to short that, you can short this above this high. You can straight up go in there and short that to go lower. Okay. So again, there's a model to long to go higher. That's one. There's a model to short this to go lower. That's two. There's a model that lets you wait for an imbalance after the high's been set. That's three. What I waited for was this retail pattern to happen. So I faded that. That's four. You see what I'm saying? So it depends on what you want to do. If you only look for specifically, let's say, the retracement after the liquidity run, which is very similar to the mitigation model. That's why that model is powerful as fuck. And yes, I'm egotistical about that model because it's literally incredible. Okay, that's why I gave it to you. And we don't really have one here. Not really. But you guys have seen it time and time again where a mitigation will just be utterly disgusting. Just for an example's sake, this is ideally what it is. Low, high, lower, low. We trade through that, right? So if we have an upside target, it's that up candle right there. Okay. If there is an imbalance or a gap that is within that, doesn't matter if it's inverted or created in the direction you're trying to trade, does not matter. That could be an entry to go long, right? Now, honestly, I don't know what the target would have been. Maybe this high. That's the equities open high. So it probably wouldn't have been equal highs, but there was a cluster of highs right there. So it would be entry, exit on one of those two right there. In, out, done. That's the mitigation model. Why is that so powerful? Is because you're waiting for a liquidity run. And then, well, the next retrace was actually down here. But post shift in price delivery, it ends up being here to go there, right? And that's why I gave it to you. It's the retracement after a run on liquidity. So the stop loss is, well, in this case, it wouldn't have been probably a really solid risk to reward, but I'm just going off today's data. I could obviously find better examples, but this is like the short and sweet of it, okay? But if things were different, say the highs were up here and it gave you a better like 1 to 3, 1 to 4 RR, that's the point. Your stop loss is going to a place where it shouldn't go to again because it's already ran liquidity. So your win rate should be pretty high if you understand the model, right? Stop runs, high probability targets, you know, waiting for those type of setups. But that's just one model. You can play a mitigation off of another mitigation. That can be another model too. You didn't know that, did you? Well, of course you did, because you watched the videos. If you recognize, okay, this was a mitigation off of, it's off of 1 minute, but it's off of a larger segment of price. You could have waited for this high, and then it trades down and into what? You have an even smaller version of a mitigation right here. Low, high, lower, low, sweeps that low, trades higher, doesn't close, but it doesn't have to. I'm not Twitter, not your teenage mentor. Doesn't have to close above that. Trades back down, this up candle, that could be a model to go higher. That entering on this with a stop right there to go higher, that could probably be an easier 1 to 3 or a smaller risk. That's not even 3, maybe 4 points on the S&P from here to here. It's only 3 or 4 points. Easy. Easy, tight stop. And I don't know what the TP would be, you know, again, somewhere in here, but I'm just saying low risk, high reward setups. So you have multiple time frames to choose from. You have top down, obviously, working from the higher time frames down to the lower. But just to wrap this up, I think having one model is going to, you're not going to take a lot of trades, bro. I mean, I've seen people go, I haven't traded in 2 weeks. In 2 weeks. If you haven't taken a trade in 2 weeks, that means you're just purposely not taking trades, because there's opportunities every day. I don't think every day is worth trading, but there are definitely opportunities every single day. And if you go 10 trading days without taking a trade, you are, in my opinion, you are doing something very wrong. You are doing something very wrong if you cannot find one trade setup in 10 trading days. You're telling me 10 Londons, 10 New Yorks, or 10 equities markets, 10 a.m. sessions, 10 p.m. sessions, and you couldn't find a trade? That's not something to brag about, dude. That's not something to brag about at all. So anyway, that's that.